Today, why housing affordability is a structural issue. Hello again, it's Martin North from Digital Finance Analytics, where I just post covering finance and property news with a distinctively Australian flavour. Today I just want to walk you through my submission to the recent inquiry into housing affordability. Unfortunately, the scope of that particular inquiry is pretty limited because they're worrying about supply side issues only, and as I've argued, it's much broader. But nevertheless, I made a submission. You can download that either from my website or indeed directly from the Parliament website. But let me take you through some of the key points that I made. I started by saying we've been tracking the ranks of inquiries into housing market and housing affordability over many years. And we note the considerable duplication of effort from the many inquiries that have been undertaken, but without yielding any real change. I argue the issue is clouded by self-interest, misdirection, and short-term political agendas. As a recent report put it, the scale of the housing market in the Australian economy and the diffuse, often disconnected spread of policy powers that address different aspects of this system makes the parable of the blind man and the elephant a perfect metaphor for a current predicament. Access to housing should be, in my view, regarded as a fundamental human right, not a commodity, yet the reverse is currently the case. The housing affordability issue is a complex and politically charged one, with a convenient separation of accountabilities between states, mainly supply-side issues such as land release, planning and zoning and building standards, and federal, where initiatives such as Homebuilder and additional first-time buyer incentives have featured alongside the tax settings. There is in fact very little joined-up thinking. In addition, neither the RBA, who sets rates via monetary policy, or APRA, the finance sector regulator, claims to have any responsibility for the trajectory of home prices, even though my research shows availability of credit is by far the most powerful lever in terms of home price growth. In New Zealand, in contrast, the Reserve Bank now has a direct mandate to consider home prices when setting monetary policy after prices soared by more than 20%, as rates were cut and other incentives were provided. Yet the real tension in terms of affordability centres on the supply of credit and the price of credit, interest rates, versus the demand for property stimulated by tax breaks or investors, migration and first-time buyers. In fact, the supply-side issues are often misrepresented by the construction sector, who always want to build more, politicians, who want to show they are, quote, addressing affordability, unquote, and the finance sector, who want to lend more, it being the most profitable game in town. In addition, no government wants to be associated with the negative wealth effect of falling home prices, nor the financial stability risk of falling values in the balance sheets of our banks, bearing in mind residential property lending is by far the biggest element in their business, more than 60%. But while there is wide recognition that the economy drives the housing market, there seems little recognition that outcomes in the big housing system have significant feedback effects on the economy itself. Housing matters in employment, income, consumption, wealth and debt. In summary, we get a convenient misdirection towards housing supply. In fact, the last ABS census in 2016 showed that there was more than 1 million spare properties across the country, and we would expect that number to be above 1.2 million this time around when the latest census results are in. And worse, the over-leverage to housing sucks the economic air out of the broader economy and leaves Australia with a weakened future as individuals are persuaded to borrow big to enter the overpriced market. Ultra-low interest rates currently make large loans affordable to many households, yet overall household debt is as high as it's ever been, and mortgage stress, even at these low interest rates, is also running hot. The Financial Services Royal Commission uncovered poor lending practice and the potential for some households to be sitting on unsuitable loans. In many countries around the world, house prices are also high, so from New Zealand to the UK, regulators are taking steps to try to limit systemic risks. These rises are partially being driven by global movements of capital, ultra-low interest rates, and quantitative easing, plus the finance sector's ability to magic loans from thin air if there are borrowers willing to borrow. Those holding investment property also enjoy tax concessions on interest and other costs and on capital appreciation. Rising wealth generally supports the feel-good factor and consumer confidence. Now, the 1/3 of households who are not property active consists of those renting and those living with family, friends or in other arrangements. Their confidence levels are lower and are not gaining from rising house prices. A relatively small proportion of these are actively seeking to buy, and they are finding the gradient becoming ever more challenging as saving for a deposit is becoming harder, lending criteria are tightened, and income growth is slowing. And we argued previously that the number of first-time buyers have switched directly to the investment sector to get into the market. Generally, younger households are yet to get on the housing escalator, whilst older generations have clearly benefited from sustained house price growth, even if more are now taking mortgages into retirement. This has the potential to become a significant intergenerational issue. But overall, the wealth effect of rising property is an umbrella which spreads widely. This sheer weight of numbers indicates that there are more winners than losers. No surprise, then, that many politicians will seek to bathe in the reflected glory of rising values whilst paying lip service to housing affordability issues. They will also start to panic if prices fall too far, too fast. And there are other winners too. For states where property stamp duty exists, the larger the transaction value and volume, the higher the income. For example, in New South Wales, in 2016-17, they drew $9.7 billion to the coffers thanks to stamp duty revenues. That's about 31.6% of the total. Optimistically, they are forecasting a significant rise in property values down the track. The higher the price, the larger the income. The tax take funds locally provided services, so ultimately residents benefit, but clearly they have an interest in keeping prices high. The banks also benefit because rising house prices gives them the capacity to lend larger loans at lower risk, and which in turn, of course, allows house prices to run higher again. Rinse and repeat. They have benefited from relatively benign capital requirements and funding, thus growing their balance sheets and shareholder returns. And whilst recent returns have been impressive, future returns may be lower, thanks to changes in capital ratios, and especially if housing lending were to moderate. On the other hand, their appetite to lend to productive businesses and commercial sectors is tempered by higher risks and more demanding capital requirements. The relative priority of debt to housing as opposed to productive lending to business is an important issue, and whilst higher house prices will flow through to economic growth in the GDP numbers, it's mostly illusionary. The truth is, lending needs to be redirected to productive purposes, not just to inflate home prices. And finally, building companies can benefit from land banks they hold and development projects despite high local authority charges. And we also note that some banks are now winding back their willingness to lend to the construction industry because of potentially rising risks. And some banks have blacklists of postcodes where they prefer not to lend, especially for newly constructed high-rise blocks. The real estate sector, of course, also benefits thanks to high transaction volumes and large commissions, and mortgage brokers also enjoy volume and transaction-related income. Even retailers with a focus on home furnishings and fittings are buoyant. But all these sectors would come under pressure if momentum ebbed. So standing back, almost everyone appears to benefit from higher prices. That is, apart from the 1/3 and rising of households renting, who tend to have lower incomes and reside in lower socioeconomic groups. But you've got to ask, is it really a free kick for the rest? Well, for as long as the music continues to play, it almost is. The question now is, What would happen if prices do fall? Remember that during the global financial crisis, Northern Hemisphere prices fell in some places by up to 40%, and several banks collapsed. Given our exposure to housing, there will be profound impacts on households, banks, and the broader economy if values fall significantly. Underlying all this, we have moved away from seeing housing as providing shelter and somewhere to live, to seeing it as just another investment asset class. This is probably an irreversible process and part of the financialisation of society, given the perceived benefits to the economy and households, but we question whether the consequences are fully understood. In terms of affordability levers, using the DFA core market model, we've built a custom model to test the relative effectiveness of different levers and the extent to which they impact housing affordability. Our model incorporates data from our household surveys and data from other sources and represents a dynamic model of the Australian economy from a housing perspective. The output from the model, which is relevant to the current inquiry, is the relative power of different levers relating to housing affordability. And here are the results. We found that interest rates and credit availability were by far the two most significant factors in play, both demand-side factors. This means that RBA monetary policy and APRA or asset lending guidance both have a direct and significant impact on affordability. Migration was the third most significant. Note that currently migration is net negative thanks to COVID, yet prices are still rising and affordability is becoming worse. The next most significant were government incentives such as stamp duty waivers or Homebuilder. These incentives, which are often targeted to first-time buyers, tend to lift prices but do not address the structural issue of affordability. Initiatives such as planning and land release, tax reforms and shared equity schemes hardly move the dial relative to the larger levers. Those are the supply-side levers. Now, we should also touch on the availability of lenders' mortgage insurance, which has a minor impact, although it does translate through to larger loans. Income growth, which of course has been depressed for years, had little immediate impact. That said, back in the 2000s, income growth supported significant price growth then, but that factor is hardly present for now because, of course, incomes are not growing. The final point then to reinforce is that any discussion of housing affordability which does not include interest rates and monetary policy and credit availability is missing around 65% of the available levers. Migration apart, which, if increased, would put more upward pressure on prices, the other addressable factors are in the minority. Thus, we see a considerable risk of the currently scoped inquiry walking past the most significant levers. That would, at very least, be unfortunate, but frankly, not necessarily surprising. Now, in my written submission, I then went on in more detail to look at the questions of financialisation, the housing elephant in the room, and some of the other underlying data. But I think that gives you a pretty clear view of my perspective, which is simply this. If you really want to understand what's going on in the housing market, you have to have a holistic view. You have to understand that the credit and availability of credit in particular, and lending standards, is by far the most significant factor in driving the current rise in prices. Of course, low interest rates helps, but the risks continue to build. And as I discussed in my post yesterday, the problem is that at one point in the future, it is likely that the chickens will come home to roost. The question is, though, when will that be? I suspect in this inquiry, we'll get a whole bunch of supply-side conversations going, and they'll go straight past this credit, interest rate, monetary policy discussion, because, of course, it's the big one. It's the elephant in the room, as it were. Different elephant, perhaps, to the housing one, but maybe not. The problem, of course, is that this is where they should be looking, but they all want us to look over there and blame the states for supply-side problems. That, of course, is a typical political ploy ahead of the upcoming election. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.